It's my pleasure to welcome into our Washington Post space Jane Fraser, who's the chief executive of Citigroup. Has worked at Citigroup for 22 years. I asked, what's something special I should mention about you? And she said immediately, well, I was a working mother. She raised two children while she was making her rise to run one of the world's biggest banks. So it's
And I worked part-time for 5 of those years for any of the women in the audience. So you can balance things.
so it's great to have you here. As everybody knows, this is the week in Davos when you just have to talk about Greenland, right? And so I'm going to start with the big question for you. Does Citibank have a branch in Nuuk?
Yes, it's one of the few countries in the world where we don't have a branch. Although I think several of us have flown over it many times. Yeah.
Well, I trust that that may change one way or the other. There's going to be a lot of business being done there. So this week, the Greenland shock has rippled through every conversation. Today, if you listen to French President Macron, he was really very emphatic, aggressive in his reaction. And he said something, Jane, that I mentioned to you, which made me think that in the aftermath of this, there's going to be some decoupling, unless there's a quick resolution between the U.S. and Europe. Certainly that was Macron's theme. And I want to begin by asking you, what is that kind of world where, decoupling or not, there's just more distance between the U.S. and Europe than there was? What does that mean for your banking operations, the way you look at your portfolio of customers and assets?
Yeah, as you'll tell from the accent, I'm not a native of the US, but I'm a strong proponent of it. I think that's wishful thinking if people think they can decouple from the US. There aren't many alternatives to the scale, the innovation, the American consumer, the great American entrepreneur who you should never bet against, the breadth and depth of the capital markets. If you want to fund a business, you tend to come to America to do so. So I think places would prefer to decouple more. They'd like to diversify a bit more, and I think diversification's a good strategy. It's just you can't do that in a hurry because the US is just too important and plays too big a role. And other countries haven't got their acts together to provide a viable alternative. So I think there's an inevitability to more diversification over time as the world evolves, but don't underestimate America.
One thing that analysts have noted is that there seems to be some movement out of dollars and dollar-denominated assets. Certainly, this was a roaring year last year for international equities, returns that were just extraordinary. Do you see that at Citibank? Do you see any pressure on the dollar? Do you think that's going to increase in this world that we're living in? And do you see a movement away from dollar assets just to diversify the?
So a little bit on Citi. We operate in 180 countries around the world. We operate as a bank in almost 100 of them. Bad English is the common language amongst the management team of Citi. We come from everywhere. And I think when you actually look at the facts and the data, there's definitely a sentiment towards less concentration into US assets. But we've watched people, when it comes down to it, where do they want to invest? There isn't the breadth and depth of the savings market in Europe. So we see a lot of Europeans still investing in US equities, US fixed income, private equity, private credit. We see the same in India. I'd have the same conversation throughout Asia. So I think the reality of what people are doing as to where versus where the emotions are, there's still quite a big difference between the two. And the data on the dollar's really not traded in that much of a different band over the past 12 months. So I think there's been a lot more talk and a desire than the reality of where the dollar is, because you'd expect if there was a big move out of the dollar, you'd see an enormous movement. And when I lived in the UK, I remember it suddenly went from $1.80 to $1.30 overnight, a couple of times in my life there. When the sterling collapsed. We've just not seen that here. And I think that again comes down to not necessarily because the US is doing everything right, but there are fewer alternatives elsewhere.
Part of what any banker, any investor does is estimate and price risk.
Yeah.
And people always say that businesses, banks, maybe high among them, like predictability just because it's easier to plan. So I'm curious how you price or factor in the Trump risk. Trump announces every day his desire to change, to be unpredictable. That's the message, yeah. But which is fine, arguably, but it doesn't make life easy for you and your business. How do you deal with I'll call it the Trump risk, but it's just the unpredictability.
Yeah, I'll talk more about what do our clients do, because as a bank we are in the service of others. We're seeing a lot more hedging. Since they were selling the dollar, we saw more hedging by companies to make sure that they weren't being exposed to real downside risk there. We saw the same with interest rates back when the regional banking crisis happened. We saw the same with commodities when the war began in Ukraine and continued. So you do see people looking at how do they navigate through volatility. They use a lot of the tools. They're not in denial that it's there, but there are quite useful capabilities that the companies around the world deploy. Other things they do is they'll say, okay, I'm going to start expanding the number of supply chains I have and not just rely on one. Now, we all remember when we all ran out of toilet paper back in the day, and I need to have some more diversified supply of it. You see some of the same things going on. No one likes to have single sources of dependency anymore. So we grew the number of suppliers that we were onboarding to provide financing to for the multinationals we serve, increased by several thousand this year. So companies and individuals react not necessarily by dumping things, but by diversification, adding more resiliency, hedging, and doing things that are sensible, so that they're not giving up on options of the future in case this too shall change.
So, I want to ask you about the U.S. economy and how it looks to you. I interviewed Scott Bessent, our Treasury Secretary, this morning. That was off the record, but he gave a session for journalists traveling with him that was on the record before that. And during that session, he was extraordinarily bullish about growth prospects for this year, and said he thinks it's possible that the U.S. will have 5% real growth, which would mean 7% nominal growth, maybe.
I hope he's right.
Yeah, no kidding. But that's Chinese level growth. I mean, we haven't grown that fast.
It's better than China.
Probably. I mean, the numbers have to be sure the numbers are not China spiked. But so, do you have a similar sense? Your data is as good as anybody's. What do you see for the year ahead first in terms of growth?
Yeah, look, I think the U.S. economy is doing just fine. It's got consumer spending has been strong through the holiday season, but not worryingly so. clearly acknowledging that there's a group of consumers in the US where it's tough. The affordability issue is a real one for many people. But overall spending has been good. The tax bill, the big beautiful bill, will deliver some pretty significant checks into many people that will be very welcome in the spring. We are seeing the benefits of deregulation, and more in terms of it's encouraging more investment into future growth and into the drivers of capital expenditure and of the economy for the medium and longer term, which is a good thing. So you've got a number of factors, and you also, American companies are more on the front foot. In multiple different industries, we have the benefit of scale, we have the benefit of the capital markets we were talking about, which no other economy does, and even our affluent and the middle class in the States has the benefit of being able to invest savings and get a return on it in a way that used to be the case in the UK where I'm from, but we've lost that equity culture. You don't have the same capital markets across Europe with options as to where to invest pensions. A lot of it's just sitting there in cash and deposits in banks. So I don't pretend for a minute that there aren't risks out there. There could be another shoe to drop with tariffs. We're all keeping a close eye on the labour market. And we look at valuations and other pieces and appreciate they're high. But I do think there's more reason to be optimistic about continued growth in the US. I think you've heard that, not just, you've heard it from across the other bank CEOs. Whereas before we've been more cautious, I think we're cautiously optimistic.
And what about inflation risk? An economy where people are getting so these nice checks and they're spending, and suddenly, people spend more. Companies may think, well, okay, we'll exceed the wage demands this year because we're going to grow. What's your concern about inflation risk in this scenario?
It's tempered, and part of that sentiment. So when we look at, there's a big difference in some of the hard and soft data that's out there. The hard data is stronger, the sentiment has been weaker. And I think as a result, what we've seen is more mindfulness from consumers. They're spending, but they're not going crazy. We've seen it in terms of, say, the delinquencies. Credit losses are lower this year than they were last year, and we weren't worried about them last year because people have been fiscally responsible. They want to make sure they're not splurging in ways that they shouldn't. So I think that balance gives me some comfort around that over-exuberance that sometimes you can see in the States when things go well. And companies are in good shape. The balance sheets are strong. So I think generally right now it feels reasonable. There are clearly affordability issues for some folk. Like the prices have gone up a lot. There's some of the tariff effects come through. So we don't want to underestimate the potential for some more pressure. But so far, pretty reasonable.
And help us with one of the mysteries of last year, which is that the so-called Liberation Day tariffs that were widely, I want to almost say universally, but certainly widely expected to have an inflationary and other disruptive effects, don't seem to have. So I'm just curious what your account would be. I mean, certainly financial markets' immediate reaction was, oh my gosh, like poof.
We had
and there was, quite a down. So what would be your account of why the bad things that were so widely expected haven't happened?
So I we have seen an impact on inflation. I think inflation is higher than it would have been right now. In fact, it could well be at the 2% were it not for some of the tariff impacts. But you're absolutely right; they're much more moderate. And there's a few different factors here. One is companies were incredibly adaptable. We were talking to some of the great multinationals, and they almost immediately, in a matter of days, reconfigured their supply chains around the world. And it's sort of breathtakingly impressive how Apple, for example, moved phones that were manufactured in China didn't go to the States. They went elsewhere in the world, and the ones in India went to the States, and that then helped the U.S. consumer. And you could name company after company on this, and they've got pretty good at adapting supply chains after the war in Russia and Ukraine, and then the COVID and the like. Then the companies also, they absorbed some of the impact themselves. I think everyone got that if you were going to put another shock onto the consumer, and that you said, okay, 100% of the impact of this was going to the consumer, it was going to be more than the consumer could bear and would have a stronger impact. And earnings growth has been good. It's been very healthy. And so I think we've seen efficiency, we've seen movement of supply chains around, we've seen some absorption of the tariffs into earnings without it causing some major disruptions. There could be another shoe to drop, as we all know at the moment. But I think it's been a bleeding through, and it's of the impact of the tariffs. Inventories were built up. There was some front loading. I think all of this has helped make it not the short, sharp shock, but more a bleeded impact over time. We're not done yet, as we know.
So another really interesting, concerning issue on the horizon is what I'd call Fed risk. People in financial markets, and I would assume you're among them, value the independence of the Fed. And I just wonder whether Donald Trump is not the only politician who thinks the Fed should have more political control. Like, who do these people think they are? That goes back to Andrew Jackson in our history. It's not a new theme. Do you, as you look at all these carefully balanced factors, is Fed risk a concern? Or putting it a different way, how important is it that Fed independence be maintained?
So I go back to, we recognize that the US is the strongest financial system in the world, has a number of different foundation components to it that have benefits for companies all over the world and savers and investors all over the world. It has benefits for everybody, having the scale, breadth and depth. And credibility is very important. Trust in financial services is really a key foundation. And the Fed independence, and that's not just a chairman, it's the whole institution, the appointments across the board, making sure that is thinking about that agenda rather than necessarily a political one is something that I think many of us do, is of critical importance and is one of the foundations of the strength of the US financial system and the role it plays globally.
Another thing that touches on your career at Citi, you were along the way, I ran Citi's operations in Latin America.
Yes. And
one thing that Trump has done that I think is sensible, without commenting on the Venezuela operation per se, I think the U.S. hasn't paid enough attention to its own hemisphere, and needs to pay more attention. And it clearly is going to. That's a central theme of Trump's national security strategy, and obviously deeply resonant with him. What do you think that's going to mean for U.S. businesses. It cuts both ways. Latin America loves America and resents America, and I'm sure these policies will fuel both. How do you see Latin America as a big growth area for Citi? Are you positioning yourself more aggressively in Latin America?
We've been in many of the Latin American countries for over 100 years. So I think we've seen the good, the bad, and the ugly in many of the different geographies there. And there's some tremendous opportunities. I think US had neglected, to your point, David, Latin America for quite a long time. And China had filled a lot of the void. China is Latin America's strongest trading partner in most countries. But now we're, so I think, seeing, and I certainly hope we'll see, a successful and mutually beneficial extension of the USMCA, which is our trade agreement between Canada, Mexico, and the US. It's been a win-win-win so far in its life, and a lot of benefit to the US economy and for our consumers and businesses. So we hope to see that extended. That would make a big difference because they're probably the most important country. But Brazil's a big market and has been closer to Asia than to the US in the last few years. And some of that's related to food and commodities, which Asia needs more than the US. But it's a good time to see America getting closer to the countries, and I think in a way that will benefit all.
Take most of our remaining 5 minutes to talk about AI, which I guess is the other overwhelming theme of Davos this year. Every other panel seems to have some AI connection. Let me start by asking you what AI is going to mean for the company that you run. I read that you have mandated that all of your employees have AI training.
Yeah.
So say a little bit about that, and then what will Citigroup look like, say, 5 years from now? I don't know what the right time horizon.
Yeah.
It'll look great. It'll be in the stock price. I'm sure it's going to be incredibly. So, but
Yeah.
I mean, it's going to be different. You're going to be able to shed labor. So tell us about training employees, and then about how AI will transform the business that you run.
The first thing we did with AI was back in, I think it was 2019, it was well pre-COVID. We put in a set of ethical principles about, I like principles as to helping guide decision making, because I think it's hard to have it entirely rules-based to guide people. I like the human spirit. But we set a number of different principles, and one of them was that it should help augment our people. It shouldn't, in that notion of how did it help them do their job, how did it help serve our customers better, without being precious about it. And that's guided us a lot. I think AI has the potential to make tremendous changes. It's going to create huge numbers of new jobs that we can't even imagine what they are today. It will change the nature of what people do every day. I use our AI tools to help me summarizing, getting information gathered more efficiently. And it will take some jobs away. We don't know whether the puts and takes are going to coincide, that's for sure. But I always think people should be as much in the driving seat as possible. So we're encouraging our people, saying not that AI is going to take your job away, but someone using AI is going to probably be better at your job than you are. So how do we equip you to use them and to use the tools? And everyone, maybe it's because I'm getting old, that I thought I could do with help in writing prompts. We all need to know how to do it in our private life. So let's give training for everybody, because there isn't a single employee worldwide that doesn't know how to write a prompt better. It will help them in life as well as at work. So that's when we started having the mandatory training for everyone, because it will help. It will help. And some people can get intimidated by the tools. So let's help support getting rid of the myths of intimidation. The other piece that I do believe, I look at it roughly 50% of all of the new job openings that we have at Citi are taken up by existing employees. And I was at one of our sites in Sioux Falls, which is in the middle of South Dakota, and it's been there for 30 years. And many of the employees there have been employees for 30 years. And they told me they've had at least 12 careers in those 30 years. They've done all sorts of different jobs because the activities that went on in that site really changed over time. So I want to stack the odds that we will help our people reinvent themselves the same way as they have done themselves, feel they've got a bit of control by having the training and the other things they need, but also encourage them to be adaptable and be honest and truthful about new jobs will come, make sure you're learning skills with them, but current ones will change and some will go away, and let's work out how we cope with it.
That's one of the best descriptions I've heard of the transition process. The idea that you've already as an employee you've done 12 different jobs, so it's going to change, but you know how to do that.
Yeah.
So, given the enormous enthusiasm, almost obsession with AI as a transformative technology. Capital expenditure for AI companies and any ancillary services that will power them, serve them, et cetera, has been just wild. I mean, it's an investment boom beyond, I think, beyond anything that I can remember. As I said to you before the session, without being, a doommonger, it's just a fact that any new wave of technology has winners and losers.
Yeah.
And what's interesting and potentially worrying here is that the losers might be very, very large, and the amounts that are lost might be very, very large, just given the level of capital expenditure. So I guess one starting point...
Sound like my chief risk officer.
Well, I'm not sure that's a good description for a journalist, but I'll happily...
He's a good man.
So I'd be very interested in what the first question, obviously, is this level of CapEx sustainable? And do you worry, again, you're in the business of pricing risk, anticipating it. What's your sense? What's the Jane Fraser sense about an AI bubble burst down the road?
I think you're spot on with some of the ways you described it. We don't know how much capacity is going to be needed. We're seeing voracious demand, and someone reminded me that when the railroads were built out in the States, a century and some ago, in retrospect, no one said they were overbuilt. But did the first investors all make money in it? Absolutely not. And I think the same is true of fiber optics and the fiber optic network. So some did well, some didn't, but it wasn't, in retrospect, overbuilt. So you end up, as a banker, you like companies that have cash flows that are strong. You like companies that have a lot of data because that makes sense for business models and other pieces going forward. But there are different models out there. And one piece is we're building AI out one way in the States. A lot of it's to serve the service economy that we have. It's the affluent consumer, more of a consumer-led. When you go to China, 50% of all robotics firms in the world are in China. Have they overbuilt in that? No, probably a bit at the moment. There's a lot of over-competition there. But a huge amount of what they're building is in physical AI because China is the manufacturer of the world and that's where their engine comes from. So I think we're going to see all sorts of variations. We'll probably see some areas where there's overcapacity and we'll see some losers. We'll also see plenty of enduring winners. I think we'll be cautious and careful to try and make sure it doesn't blow up the systems in the meantime. but it is exciting, the innovation that's going on. But I think your words of caution are warranted. Not everyone is going to end up with a rich bank account at the end of this, and we need to keep that in mind.
So, Jane Fraser, an amazing tour of the global economy. Thank you so much for joining us. Please join me in thanking Jane.
Thank you. Thank you for joining us.